Good afternoon. I thought we might get started. My name's Desmond Lochman. I'm a resident fellow at the American Enterprise Institute, and it's my pleasure to welcome you all here to this afternoon's discussion that I'm sure will be rather interesting given the really very strong panel that we've been fortunate enough to assemble. I should also say at the outset that I'm happy to be doing this event together with Nigel Chalk at the International Monetary Fund, and I look forward to future collaboration with the International Monetary Fund on these kind of issues. To say that since the Great Economic Recession, we've moved in economics into uncharted territory and that we've really got to grapple with the new normal would be an understatement. And that is certainly the case, with regard to labor market issues. There are just so many different ways in which the labor market isn't the same as it was before. And I could think of, if you look at participation rates, for instance, participation rates now are down to levels where they were 30 years ago. That has to raise questions. Are the participation rates going to come back? You look at unemployment. Unemployment we saw during the cycle went to the highest, practically the highest level in the post-war period. It's now come back that we've got unemployment now around about 6%. However, if you look at long-term rates of unemployment, they're still very high. If you look at the amount of discouraged workers, that is still a problem. The number of people working part-time involuntarily, that's another issue. So it raises the whole question of how much slack do we really have in the economy? How much further can we go? You look at productivity trends, disappointing productivity trends after the burst in productivity in the late 1990s. We're now back down to below 2%, raises issues as to whether or not we're going to be returning to high productivity or whether somebody like Robert Gordon is right that the best is behind us. So these are really some of the issues we'll grapple with this afternoon. I think if you look at the labor market, there are two basic issues that hopefully our panel will shed light on. The first is a short-run issue. It's a question of how much slack is there really in the labor market? Are we approaching a level at which we've got to worry about inflation rising, or is there plenty more room to go? Can the economy grow above its potential rate for a period of time? The second broad area is probably even more important. It's the longer run issue, which deals with what is the United States' potential now. Has the United States gone down to a lower potential growth rate? The fact that we've got lower productivity, bad demographics, does that all mean that we now should be expecting to grow on a long-term basis at a lower rate than before? Or are there a variety of policies that can change that picture and that can put us on a higher growth path? So those are the broad issues that I hope the panel will touch on this afternoon. So I'm going to have them speak in the following order, and I'm not going to give too much of a background to them. You've got that in your package, what their bios are. I'm going to ask Nigel Chalk to begin first. He is a deputy director in the IMF's Western Hemisphere department. He leads the IMF missions to the United States. He recently completed one of those Article 4 missions, found interesting conclusions. We'll then have Betsy Stevenson speak next. She is a member of the President's Council of Economic Advisors. She used to be chief economist at the Labor Department, and she's taught at Michigan University. We'll then have Erica Grosjean, who's the Commissioner for Labor Statistics. has experience at the New York Fed as well. And last but not least, we'll have Larry Meyer, who is a co-founder of Macroeconomic Advisors, a very well-known economic consultancy group, and probably better known before that for being a governor at the Federal Reserve Board. So with that introduction, it's my pleasure to ask Nigel to begin. I've asked each of the speakers to speak for around about 10 minutes, and then we'll throw it open to question and answer. Thank you.
Thank you, Desmond. So I have 10 minutes, so velocity will be adjusted appropriately in order to cover the content on the presentation. So I want to talk about America's disappearing workers. I'd hoped there would be an economist front cover that would show the American workers disappearing, but unfortunately we couldn't find one, so you're just going to have to deal with this graphic. I'm going to talk about a little bit about slack, as Desmond said, and then focus more on the long-run growth issues, which we think is probably the more important questions, and talk a little bit about policies. So as Desmond said, the labor force participation rate's been coming down, and it's now back to where it was in the early 80s. This is what I think of as the disappearing workers in the US. It's been a secular downtrend. If we went back and before the crisis thought about where labor force participation dynamics were going, the BLS, and it was obviously before Erica's turn there, had said that this was what was going to happen, looking at long-run demographics. This is what actually happened, as you saw it just disappearing. The labor force participation rate just crashed following the crisis. And we've done some research trying to look at what was going on there, how much of that was reversible or non-reversible. And I'll get to that, and the authors of that research are on here. So when we look at the demographics, just purely the demographics at an aggregate level across the country, it would suggest that this should have been happening to the participation rate, which means that the cyclical factors were quite important in driving participation much faster than it would otherwise be. But when you look at that, it's very important when you think the original, the starting period was, when you think the labor market in the US was at equilibrium. Here we show a starting period from 2007 and projecting forward from there. But if you thought that was above where equilibrium would be, then if you go back to 2005, you get correspondingly lower labor force participation rate. And we've kind of taken that green line more or less is where we think the economy should be heading back to. And so we think going forward that our forecast is that cyclically you'll see the labor force participation just leveling out for a while for maybe the next 2 years. And then it'll start going back down again as it joins back with that long-run demographic trend. So this is, I think, relatively uncontroversial, or at least it was until the Brookings paper put out by the Fed, where I think they would regard a lot more of the decline post-crisis actually being structural and linked to long-run demographics. So we looked at this issue from another perspective, is by trying to exploit some of the variability in the state-by-state data. So if you look at the state-by-state data, we can obviously look, there's a lot of heterogeneity in how labor force participation has varied across the states, and there's also heterogeneity in how the cycle has affected the different states. So we try to extract from the state-by-state data, using cyclical measures of the employment gap, how much we could reasonably think of the decline in labor force participation rate as being cyclical. So this plots on the one axis the labor force participation decline that actually happened in the states, and on the y-axis you see what we would predict from the cyclical model that we fitted to the data. And the bottom line is we think around 30 to 40% of what's actually happened can be explained by the cycle, which leaves the other 60% part demographics and part things we just don't understand. So if that's true, then, which is our view, is you've actually got a lot of labor market slack. You've got the participation gap, which I showed there, as the participation rate goes back to normal. You've got a part-time employment gap, and there's also unemployment. And so we end up with a very large output gap, which means that we don't think there should be much inflationary pressure coming anytime soon. And so as a result, for monetary policy, we think the liftoff can wait, at least for a little while. I think Larry will have a different view on that. But unfortunately, the data is not as convenient as we would hope it would be, and we're seeing very ambiguous data in the wage data. So this is what we really look for in the wage data. If we really have labor market tightening, although it's going to be a bit of a lagging indicator, we should see some wage pressures. Now, if you look at employment cost index, we don't really see that. But if we look at average hourly earnings, we see more pressure. And particularly if you disaggregate the average hourly earnings into different subsectors, you see a very strange pattern. You see areas like mining, which presumably is linked to the fracking, driving up wages in those sectors. You see other areas like non-tradables and services, particularly in education, health, financial services, where actually labor average hourly earnings are coming down, or at least increasing at a slower rate. And then you've got things like leisure, hospitality, restaurants in between, which are sort of going up 3% faster than the average, but not as fast as some of the mining sectors. And then when we look at unit labor costs, we're again sort of left with a bit of a puzzling picture. There doesn't seem to be a whole lot of unit labor cost pressure. And presumably, if you were worried about pass-through to inflation, you'd want to see some labor costs that are going up faster than productivity. Sort of an ambiguous picture as to whether that's happening. So that's the inconvenience of data to our story. Let me switch now to talk a little bit. I think the more important question is if it's true that labor is disappearing in the US, this is going to have very big implications for not only US long-run growth, but also for global growth. We started thinking before the crisis that the US long-run potential growth rate was somewhere around 2.8%, sort of closer to the 3 level. We obviously overreacted in the crisis. This is a picture showing our forecast of long-run potential growth in the US through time at each World Economic Outlook iteration. So after the crisis, we really reduced our rate of long-run growth, and then we put it up to around 2.3. And since 2010, we've been gradually reducing our long-run growth rate. You'll see 2013 there. I don't know who was responsible for that number because that wasn't me. But generally, the picture is that we've seen sort of a decline in long-run potential growth as we've revised our views not only about labor force participation, but we've revised our views about productivity. Unfortunately, we're in reasonably good company. If you look at the FOMC, the average of the dots from put out by the Fed, they're also significantly reducing their view of where long-run growth should be. And they're closer to sort of the 2 to 2.25 range now. And as well as the labor force, as I mentioned, we've got a productivity decline going on in the US, and there's a really unclear picture as to where productivity is going to go going forward. And I think that where productivity goes will not be independent of policy, so I want to talk a little bit about that. We looked at, again, we tried to exploit some of the differences in the states data to try and get a better picture of what's driving productivity growth, and particularly what on the policy side could be done to change what's happening in productivity growth. So the authors of that study is here. As you can see, every state in the US has seen a decline in the productivity growth and TFP growth since 2005. But the magnitudes of that decline have varied greatly across the states. New Mexico is our poster child for the biggest productivity decline, and Oregon's probably the best case. And there's unclear why that's happening. When we look, a lot of the story people would cite is the technology story. When we look across states, if we look, cut the states across whether they are either intensive users of IT or intensive producers of IT, and we plot those against the change in productivity growth that's happened over the past few years, this doesn't seem to be very much of a relationship. And we think that the IT is an important component, but when you look across the states data, it's obviously something else is going on that's as important or more important than just an IT story that's accounting for this differential change in productivity growth. When we look at the production frontier, so we try and use this state data to calculate what the sort of optimal efficient production frontier would be for output per worker across the states. And in 1996, the picture's here. What happened over the past several years was, yes, there was productivity growth, so the frontier moved out, but you saw more and more of the states actually falling behind the frontier. So the distance from the frontier, the efficiency by which the states were combining capital, labor, and technology was diminishing. And so then we tried to explain what was the difference across these states. And we find we've done sort of large panel regressions, just to full transparency. We actually really wanted to show that infrastructure was a difference across the states, but unfortunately, again, the data didn't cooperate. But what we did find was actually the things that really mattered were schooling, educational attainment, and particularly education outputs, not education inputs. We found that R&D spending, both by the private and public sector, mattered for how far these states were falling behind. And we also found that poverty mattered. And we've done a similar set of exercise where instead of looking at the difference from the efficiency frontier, we just looked at purely trying to explain the decline in TFP growth across the states, and we find some very similar results. So let me get to policy. So we think policies matter. We think particularly policies linked to poverty really matter. If you are a country that's facing a disappearance of your workers, you want to make darn sure that you get the most out of all the workers you have. And there's a lot of evidence that those families living in poverty, they both invest less in human capital, they're more likely to transition out of the labor force, less likely to transition out of unemployment. So we think the small investments, relatively small investments, in bringing some of these groups out of poverty can have large effects not only on labor force participation, but on long-run productivity growth. So we would point to things like the EITC, making that more generous, expanding the coverage of the EITC, particularly for families without children. We think that's a mechanism to give people that little bump in order to get them back into the labor force and get a sufficient amount of resources to invest in human capital. And when you look across other countries, US's minimum wage is relatively low, and we think that a combination of expanding the EITC and raising the minimum wage could be enough to help with those income distribution issues. Secondly, I think active labor market policies. So what we're thinking here is training, job search support. Perhaps given the stigma effect of long-term unemployed, you might need to think about subsidies for the long-run unemployed, for hiring long-run unemployed. And when you look at the US spending on active labor market policies relative to all the other industrialized nations, you can see it's a little red box in the bottom, so obviously not very much being spent there. And then there's issues in terms of participation related to female access to the labor force, to second work earners returning into the workforce. The US taxes quite high marginal rate those second earners coming into the labor force. So we think changing the tax regime in order to reduce that marginal tax rate, and then investing in things like subsidizing childcare, we can also help with labor force participation. Finally, I'm going to skip over the other things. I think the other thing we've highlighted in the report is immigration reform. When you look at the US performance in terms of immigration reform, in terms of the highly educated members of the population, the US lags behind many of the other industrialized countries in terms of bringing in highly educated workers. And what's interesting in the US, if you look at the pool of workers that are being brought in through immigration in the US relative to the pool of highly educated workers in the US, you're actually bringing in on net a lower quality of education group of workers than you would had you had a more skills-based policy. So we think a skills-based immigration reform is important. And it's really the only thing that we can think of that drives us. You get a three-fer. You get strong labor force participation improvements. If you make it skills-based, you get productivity improvements linked to human capital, and it also happens to help you on the fiscal, particularly over the longer horizon, given aging. I'm going to skip over it. So we think infrastructure is important. We think innovation, education, subsidizing R&D is also important. The US, just on this picture, does terribly in terms of the amount of money it spends on education relative to the amount of quality it gets in terms of both academic performance on tests and things like ratio of students to teaching staff. Let me just come up with the conclusions. So long-run trends are going to be working against growth in the US for a long time, and they need to be addressed. When we look at slack, we think there's a lot of slack still left. But there's a lot of uncertainties, and particularly the labor market data gives us quite a different picture depending on which indicator you look, which is good for the financial services industry because they can all choose different data and spew out different reports, but it's not good for sort of economic analysis. But it makes it complex to judge monetary policy, and I think given the complexity, our sense is, well, you allow for some, maybe you end up being a little bit behind the curve in trying to repair the labor markets, and that's okay. Long-run growth, I think this issue might be lost in the debate because everybody's very focused on the short-term slack issues, but it's very serious for consequences for long-term growth. And pretty much the policy actions are clear, but there's little political consensus, I think, around those policy actions. So let me stop there. I told you velocity would adjust.
Right. Nigel, thank you very much. You've really raised a whole bunch of issues, and I'm sure others will have a lot to say about them. But could I just ask you a couple of questions for clarification? If you've got such a large gap in the U.S. Economy, how come isn't one seeing that in terms of deceleration of wages? The fact that wages or inflation are leveling off or perhaps picking up, doesn't that give you some pause about what you think the gap is?
Yeah, I think that's true, but you never saw, I think there's two mysteries. You never saw wages contract like you should have seen, and now you're not seeing them pick up, but some indicators are picking up. So, like I say, what I would look for is for wage inflation in non-tradable sectors. I would think that would be a good indicator in the service sectors. If we started seeing a lot of wage inflation in those sectors, but there the picture is very mixed. So I think the aggregate statistics kind of maybe hide some of what's going on at a disaggregated level. I mean, the US, you don't see any goods inflation. It's all services inflation. If you're going to tell a story where wages are driving services inflation, then you should react from monetary policy. Then you need to see those those wages in the service sectors going up, and I think there it's a very mixed picture.
Are you at the high end of estimates in terms of the labor market gap?
I think we probably are. I think we're increasingly moving at the high end. Yes.
Thanks a lot. Bessie, would...
Thank you. It is a pleasure to be able to be here today to talk about the state of the labor market. And I wanted to start by just sort of reminding everyone where we are right now. The economy has noticeably improved across a broad range of economic indicators over the past year. Second quarter GDP, as all of you are probably aware, rebounded quite strongly after the negative first quarter. And over the last 4 quarters, real GDP has risen 2.5%, faster than the 1.8% growth observed during the previous 4 quarters, or as I show up there, the 8-quarter period, preceding 8-quarter period where it was growing at real GDP was growing at 2%. Manufacturing's been particularly strong. The ISM index has reached its highest level in over 3 years. The Conference Board Sentiment Index in August reached its highest level of the recovery. And the job openings in July were higher than the 2007 peak. Perhaps no economic indicator has been more surprising than the rapid fall of the unemployment rate and commensurate pickup in job growth this year. For most of the last several years, the blue chip consensus forecast expected the unemployment rate to be around 7%, but instead the unemployment rate's just over 6%, approximately 3 years ahead of these forecasts. This general pattern of steady decreases in unemployment holds across genders, age groups, and race and ethnic groups. We've taken a look at it, breaking it down by different measures of unemployment across different groups. And what you see is a sort of pattern that's pretty uniform across different measures, which is looking at about 70 to 80% of the way recovered across groups and across different rates. So obviously, the unemployment rate is still too high, and there remain many open questions about how many people not counted among the unemployed can be easily pulled back into the labor force. And of course, now that we're at 70 to 80% of the way recovered, it's time to talk about, even when it returns to its long-run level, what kind of challenges will we still face? The Council of Economic Advisors, we've identified 5 related challenges, all of which both reflect trends that predate the recession, as well as the consequences of the recession, albeit to different degrees. These challenges include the long-term unemployment, and as the long-term unemployment rate still remains quite elevated, I think what's less appreciated is that long-term unemployment as a share of unemployment's been rising actually quite steadily, going all the way back to the 1970s. So as I said, it's part both of a trend that predates the recession as well as clearly a consequence of this recession. The labor force participation rate, people working part-time for economic reasons, the decline in labor market fluidity, and increased inequality in wages and income. So those are our 5 related challenges. And they're all areas that the administration's thinking actively about. In my remarks today, I'm going to focus on the participation rate. The Council of Economic Advisors has recently, or this summer, released a report where we took a detailed look at the unemployment or at the participation rate to try to understand, what has been happening with it. So, unlike the unemployment rate, and other indicators of labor market utilization, the employment rate has not recovered as rapidly, and labor force participation has not recovered as rapidly. We've now seen 54 consecutive months of private sector growth, but the participation rate has fallen over the course of the recovery, although it does appear to have stabilized since last October. But the question is whether we should have expected it to recover, and as Nigel has pointed out, no one expected it to recover all the way, because before the recession, many people anticipated that it would fall as the baby boomers began to retire. And sorry, there is unemployment rate coming down. I should have advanced my slides earlier. And here is the participation rate. One of the things I think that's underappreciated is that 2008 marked not only the beginning of the worst economic downturn since the Depression, but also the year that the baby boomers hit age 62 and began to retire. So even though this decrease was predicted, it's still important to investigate the magnitude of the decrease and what it means for different groups and the outlook for the participation rate. So what I want to go through is what we did in our report was to decompose the decline in the participation rate into three factors: the aging factor, how much a cyclical component, and then what remains once you've accounted for the cyclical component and the aging component, a residual or unexplained, and then we spent some time trying to look into what accounts for that residual. So you can see here that in that decomposition the last couple of years, the aging effects do explain a lot, but there is both a cyclical and residual to consider. So the aging, let me comment, as Nigel said, it's very important to what year you begin with when you're thinking about the decline and decomposing it. We took 2007. I don't think that that's sensitive in terms of understanding the causes of the decline, but when it comes to measuring the magnitudes, it's very sensitive to what year you pick. So picking from the fourth quarter 2007 to the third quarter of 2014, the participation rate fell by 3.1 percentage points. The aging of the population accounts for 1.7 percentage points of that decline, slightly more than half of the total decline. Although older workers today are participating in the labor force at higher rates than older workers of previous generations, and that does sometimes confuse people, older workers participate at much, much, much lower rates than people who are young or in the prime working years of their life. So these changes in older workers participating more is very small compared to the drop-off that occurs when workers enter their early 60s. And of course, we shouldn't expect, as the population continues to age, this to rebound just because the economy recovers. We looked at estimating the remaining business cycle effects and found that typical business cycle effects are currently responsible for an estimated 0.4 percentage point of the decline in the participation rate, or about 1/7 of the overall decline at this point. Elevation in the unemployment rate typically coincides with a decline in labor force participation as potential workers defer looking for a job until the economy improves. So as the unemployment rate continues to come down, participation should improve, and when the unemployment rate has fully recovered, this sort of standard business cycle effect should pull in roughly another 600,000 workers into the labor force. Now, the remaining 1 percentage point of the decline in the participation rate, or a third of the decline since the end of 2007, is not fully understood. In our econometric analysis, we find that this portion is not easily explained, and easy is a very important word here. It's not easily explained by either the aging of the population or standard estimates of the impact of the business cycle. There are several possibilities that we've considered for this additional decline. One thing that seems to explain at least a portion of the decline is the very severe recession, in particular the large increase in the long-term unemployment rate. Our results found that taking the duration of unemployment into account leads to a larger role for participation to rebound as the unemployment rate recovers, and therefore further declines in the unemployment rate that are driven by declines in the long-term unemployment rate would bring back even more people than predicted by the conventional cyclical effect. However, it may also be that our specification attributed some continuation of the pre-recession trends of declining participation rates for many groups into the residual. For example, the participation rate among prime-age men has been decreasing for more than 60 years, and while the drivers of these trends are not fully understood when you're looking at a 60-year trend, a sensible forecast may be to expect it to continue. I think more puzzling is the decline in women's participation that occurred during the 2000s and whether a sensible forecast is to expect that to continue or not. Finally, there are some structural changes in the labor market, such as the decline in labor market flows, that may have exacerbated the decline in participation for a given rise in unemployment. I think that is a really open question at this point and clearly an area that warrants more study. So looking at why the participation rate has declined in recent years can help us predict what may happen in the future. And I think our predictions are pretty much in line with Nigel's predictions, which is that the aging population is expected to push the participation rate down by about 0.2 percentage points per year. And as the economy continues to recover, that will be offset somewhat by the cyclical component of the decline as that disappears, adding 0.4 percentage points to the participation rate spread over a number of years. The portion of the decline in the participation rate due to unexplained factors is unexplained, so therefore difficult for us to predict. To the degree it's the result of non-aging trends, then a continuation of these trends could further lower the participation rate. Alternatively, to the degree that they are due to long-term unemployment rate or other unique aspects of the Great Recession, then as the economy continues its healing, this effect should disappear, putting additional upward pressure on the participation rate over a number of years. Without policy changes, however, a meaningful increase in the long-run participation rate from current rates does appear unlikely. And across a variety of possible scenarios, which I've shown up here, the participation rate is likely to be roughly stable in the near term and will decrease more rapidly after the economy returns to full employment and the effects of population aging once again dominate. So the participation rate is, of course, not a goal into itself. If more people retire solely because they are older and have saved and contributed for their full working lives, that can be a natural and beneficial development. Likewise, if young people are delaying entering the labor force because they're studying and investing in human capital, this development will increase our skilled workforce in the future and benefit our long-term economic performance. But the declining participation rate also subtracts from potential economic growth, as Nigel has pointed out, and exacerbates future fiscal challenges. Moreover, not all of the decline in participation we've seen is the result of natural and good developments. In fact, the long-term trend of declining participation and employment rates for many groups, such as prime-age men and particularly young black men, is troubling and merits a policy response. With women increasingly among our most skilled workers, boosting their participation and attachment to the labor force is essential for strengthening growth. To this end, the President's pursuing legislative and executive actions to promote equal pay and to consider further avenues for which policy can help encourage women to participate to their full potential. He is also supporting programs that encourage women to pursue careers in traditionally male-dominated fields such as science, engineering, and technology. Increasing numbers of American workers report conflicting balance about their work and family obligations. And I think a statistic that everybody should know and consider is about half of all parents report that they've declined a job because it would have conflicted with their family responsibilities. Therefore, the President is working with employers and state and local governments to move forward on paid leave, greater workplace flexibility, and other policies that will help remove the obstacles that lead parents to turn down jobs in which they may be more productive and better able to contribute to the economy. To support young men of color whose declines in labor force participation have been especially concerning, the President has launched the My Brother's Keeper initiative, which will determine the public and private efforts most effective at helping young men of color succeed and help bring these programs to scale. That initiative focuses on encouraging young men to remain on track in school, complete post-secondary education, enter the workforce, and stay out of the criminal justice system. Supporting young men of color throughout these life stages will help connect them with the labor force and ensure that they reach their full potential professionally. Finally, let me end by saying that building labor force attachment among young people can raise their labor force participation throughout life. An often overlooked policy to build labor force attachment and to increase productivity is the President's Preschool for All plan. For sure, this is not a rapid road to expanding participation or productivity, but it's a well-tested one. Studies like the Perry Preschool Evaluation show that access to high-quality preschool boosts labor force attachment and earnings. And more immediately, the President has announced earlier this year expansions to apprenticeships that will train young people for high-demand jobs and help them build relationships with employers. Additionally, providing funds to community colleges to implement job training programs targeted to the skills and credentials demanded by businesses. The President has similarly committed to redesigning high school curricula to focus more on industry-relevant skills. All of these initiatives aim to give young people labor market skills and connect them with employment opportunities, raising their labor force participation over the long term. Over numerous dimensions, labor markets has improved, but major challenges remain. Even at a strong pace of recovery, the depth of the recession means that the recovery will still take more time. And even after we're fully recovered, the job market will face a number of challenges that have a meaningful structural dimension that predate the Great Recession, including not only the participation rate, but as I started, long-term unemployment, people involuntarily part-time, the degree of the labor force churn. The good news is that we're making progress on all these fronts and actively exploring all of these issues, and I look forward to talking more with you about them on this panel.
Thanks a lot, Betsy. I just wonder, before turning it over to Erica, whether you could give us some indication, what does this all mean for long-term potential growth? Do you have estimates on that? And I guess the second question, that I was wondering about is, when people drop out of the labor force and then they go on to welfare and stuff of that sort, might there be a sort of a tax trap that they lose out a lot by coming back in the labor force, so that we might be in a different circumstance this time around?
Let me say that start with the growth question. I think Nigel laid out there the fact that when you have less people participating, you're going to have lower growth. I don't think our estimates differ that much from the ones that the IMF has. I don't know the numbers off the top of my head. But there's, when you have, I actually do have a stat on the top of my head that will help you think about this, which is the increased participation rates of women since 1970 and the closing of the gender pay gap since 1970 has added $2 trillion to our GDP. So, these issues, who's participating and what they're able to do when they're participating have big implications for the macroeconomy. To your question about various programs, we actually took a close look at the disability insurance program to see, did that rise more than one would expect in this recession? And we found that it did not. That the rise in disability was actually even slightly less, but basically on track with what you would expect given the increase in unemployment and given the the aging trends, because of course it's related to aging as well. So, there's no particular reason then to think that that type of program is going to be more difficult in this recession to come out of than in previous recessions. I do, I think when we look at indicators of what hasn't recovered as fast as one might have expected. So let me say two things. One is the rate in which the unemployment rate has come down has exceeded the rate at which you would expect given previous financial crises internationally. The decline has actually been about on average of what you would expect from previous downturns. So the unemployment rate's come down as fast as we would have guessed, so indicating something's not holding that up. And the only measure that's not coming down as fast as one would like, it's not measures that include marginally attached or discouraged workers. It's measures that include the involuntary part-time workers. So those guys are actually in the labor force, and participating, but say that they want to work more. And that rate has not come down as quickly.
So you're looking at something like U6.
Exactly, where you see a recovery. That is where we see the smallest percent recovered compared to some of the other measures.
Right. Terrific. Thanks again.
Well, good afternoon, everyone. Thank you for having me. It's an honor to speak at AEI and at this IMF event. It's really important for us at BLS to tell our users what we see and to hear from you what you see in the data and hear your feedback on the data itself. We take this seriously because we know that we are the source of some of the most important decisions being made continually by families, businesses, and policymakers across the country. I want to thank my fellow panelists, Larry, Betsy, Nigel, and Desmond, for moderating. And while I can't comment on whether or not what we see is the new normal or on monetary and fiscal policy, I hope to share a little bit about where we are in the labor market and to kind of maybe sharpen the puzzle a little bit. So, let's see, there we go. So, as everyone has said, we've made a lot of progress since the recession ended, and yet challenges remain. And I don't have participation on this list because I knew Betsy was going to talk a lot about participation. But we still, what I want to go through is long-term unemployment. I want to call attention to quits, firm births, compensation, and then talk a little bit about where we might be in the future. So, long-term unemployment is still very high, and one of the really distinguishing features of the most recent recession and the recovery is this. This is the share of people who are currently unemployed who report that they have been unemployed for 27 weeks or longer. And so you see this huge increase during the recent recession, far larger than you saw during the past two recessions. So in December 2007, it was 17.4% of the unemployed reported themselves as long-term unemployed. This rose to 45.3% in April 2010. And it's been trending down since then, but it still stands at 31.2% in August, which is about half or double the level that we saw in 2007. So this number is really high, and I think there's some very interesting questions. Of course, who are they? But there's another question that really ties into this participation question, which is you have to realize that we ask this question, how long have you been unemployed, of people who are unemployed now, right? Who meet the criteria for unemployment right now. They are ready, willing, and able to work. They have looked for work within the past 30 days. And their answer is one, we don't make them justify how long they've been unemployed. They simply report, when we say you're unemployed, how long have you been unemployed? So if during that period of time, the more than 27 weeks, they've had spells out of the labor force, and don't count them when they report them, then this may be reflecting some of these flows in and out of the labor market that you don't pick up on at this particular moment. So these folks could have been marginally unattached. They could have been discouraged for part of that time. They could have been taking part of the care of their families, etc. So which gives you a sense of many of these folks may well be on some of this margin that we've been talking about, and could be part of some of this unexplained increase in labor force, the decline in labor force participation, because they're doing some of these transitions back and forth. Although no one has been able to people have looked at this in the flows, and there isn't a simple story there going on. Okay, let me push ahead. Another thing that I want to call your attention to is that quits are actually a sign of a healthy labor market. Quits reflect people being poached, by other employers. It reflects people who feel confident enough that they might want to quit work and look for jobs elsewhere. All right, so this information comes from our Job Openings and Labor Turnover Survey, and it gives you the number in thousands of people who have quit in the past month. There are voluntary separations initiated by the employees. What you can see is that the recession led to a large decline in the number of quits. All right, and since then, we've had an increase in the number of quits, but we are still not back to the levels that we were seeing before the recession. So in July 2014, we had 2.5 million quits, and that's still below the 2.8 million quits in December 2007. So while the number of layoffs has fully recovered in the economy, we're still not getting this kind of fluidity on the part of the workers that we had before. We're still below pre-recession levels. Another element in that is that job gains from establishment births have declined. So this comes from our business employment dynamics data set, where we look at what's going on with establishments. And the blue line shows you the number of jobs gained from establishment births from 1993, I guess that is, through present. And you can see there's an overall decline, but which is troubling, but especially you see virtually no recovery since this recession in the number of job gains from business births. Right. So we had the series high was in March 1998 when we had 1.3 million jobs gained from births. The low was March 2012. We had 600,000, and now we're about around 700,000. Anyway, so we are still way below. So this is a major problem. Now you'll see that the job losses from deaths are also down. All right, this is so, and that's not so surprising because young firms have a much higher probability of dying than older firms. Okay, so that's not surprising. But okay, another important factor, and this is something that that Nigel touched on. Wage and benefit growth remain very low. This is from the employment cost index data. So this is adjusted for skills. This is skills adjusted, and I show you three lines here. One is total compensation, one is wages and salaries, and the other is benefits. The lines aren't very clear. The volatile one, the one that goes up really high and bounces around, is what was going on with benefits. I think that's right. But what you can see is that maybe there's a little bit of an upturn lately, but but compensation growth has been very, very subdued since the recession. All right. It's been historically low. Now, there have been some pockets where we've seen some increase in compensation, mining, but mining is a very tiny part of the economy. It's growing, but it's a very low base. Right? It's very hard to see increases in compensation really much of anywhere. Okay. I'm going to push a little further. This is a very long-term graph. This goes from 1947 through 2013. And the blue line, the blue part, shows you what's happened to hours in the U.S. economy since 1947. And we have had an increase, obviously, in the number of hours worked, but that's been really dwarfed by the increased output that's come from productivity increases, which is what shows up in the green part. So we've had, the U.S. has been able to produce a lot more real output over time without a proportion increase in hours worked. So we've had an 8-fold increase in output at the same time that the hours index has not quite doubled, right? So we've had this huge increase in productivity, but when you then look at the productivity index and compare that to real hourly compensation for the same period, 47 through 2013, you can see the compensation kept pace with productivity until the early 1970s, more or less. And since then, we've had more and more divergence. So from 47 to 73, productivity grew at an average rate of 2.8%, and compensation grew at a comparable rate of 2.6%. But from 73 to 2013, productivity was at 1.8% growth, while compensation grew at half that rate, 0.9%. So this is a huge factor in the changing U.S. economy. All right, so I don't run out of time. Let me sum up. I'd say we have ample evidence of labor underutilization despite the recent improvements in the labor market. We could talk about some other things people have mentioned, part-time work for economic reasons, and the particular component there that has really lagged is in the portion of people who would prefer full-time work. So it's not so much in the slack work component where employers have cut wages, cut hours, but it's in the people who have a part-time job and would prefer to have a full-time job. We've seen low wage growth and a decline in labor share. These, I'd say, rule out a broad skills mismatch story, or even an insider-outsider story for what's going on. There are other candidates: deficient demand, growing corporate concentration, globalization, technology. I don't think these, I think there's room for a lot of research to be done on these things. All of these explanations and understanding the policy solutions and the choices ahead of us require data and analysis. So let me finish by saying, where will we be in the future? Well, one thing I hope is that we will still have the data that we need to be able to make these choices. And we in the statistical agencies face a lot of challenges that I'll just share with you briefly. We face declining response rates, mostly on the household side, not on the firm side. We at the BLS have managed to keep our establishment response rates high, although it's taken a lot of work on our part, and we could use all the help you can get to convince establishments to respond to our surveys. We think they're being affected, but on the household side, everybody who owns a telephone knows how many calls you get from people purporting to do a survey on you. So there's respondent fatigue, there's also mistrust, and these are challenges that we face. We face another challenge, which is attracting and keeping workers, especially the high-skilled workers, because these days of big data, we want them to be applying their big data skills for us, and they have more opportunities than they had in the past, and especially as the divide between government compensation and private sector compensation grows. And then finally, and very immediately, particularly for fiscal year 2015, but also beyond, those of us in the statistical agencies face more and more uncertainty about what our level will be with continuing resolutions, with threats of various kinds of those sorts. So we face higher uncertainty, which makes it difficult for us to spend our money rationally, and of course we face a lot of concern about our levels of funding. But the main thing is that we're doing everything we can to provide you the data you need to make the policy choices that we know are so important. Thank you.
Thank you. Just one question. Sure. The chart you put up was actually quite impressive, the divergence between the compensation and the productivity since the 70s. you ascribe that to globalization and technology?
There have been lots of reasons that have been brought forth, skill-biased technological change, international trade, but also institutional changes, such as decline in unionization, decline in the real value of the minimum wage. Those have also been positive as reasons.
Great, thank you. Larry.
Well, Desmond, thank you very much, and thank you for inviting me. I'm coming from a very different place. I spent my life thinking about monetary policy, and what's happened in the labor market since the Great Depression are a great challenge to monetary policymakers, but they also provide unique opportunities for monetary policy. Now, when I was growing up a long time ago in economics, we used to laugh at what we call Say's law. Say's law said that supply creates its own demand. You got the potential level of output, don't worry, demand will always be at full employment. Okay, Keynes had a little problem with that. But today there's kind of a new view, and that view is that demand may create its own supply. And we're going to see that play out a little here as I talk. Now, before I go further, I want to say, Desmond, that I'm not going to accept without question the notion that there's a new normal. Sure, there are demographic changes that you can't fight. Those are just inevitable, so I'm not going to talk about those. What I'm talking about is the shocks from the Great Recession and the legacies, and whether those legacies are inevitably permanent or may not be, and what policy can do about them. Now, I'm going to talk about 3 shocks. So here we see the short and long duration unemployment rates, and that gray area is long duration unemployment. Okay, and as Erica mentioned, that a unique feature of this cycle is the unprecedented rise in long duration unemployment. So we're going to come back to that and think about what the implications are. The next one is U6 has come up already. That's a big part of my story. And again, we see what's unusual is that an unusually large gap has opened up between U6 and U3. I want you to keep in mind that short-term and long-term unemployment duration, they move together, okay? As do U6 and U3. So we're only interested in this to the extent that that relationship changes and that one becomes unusually high relative to the other. And I'm going to come back to those in a minute. One of the most fascinating, and Erica talked about this, is the stagnation in real wages. Now, I'm not going to talk too much more about that, but I think you had a hint of this. This is not unique to the period after the Great Recession. It's been going on for at least 15 years. The share of labor income has been declining. So you want to talk about income inequality, we kind of know what's going on. And so that's a very important thing. And we'll ask a little bit about whether that's subject to normal kinds of policy. Okay, now I want to come back here, and there are a couple of issues here that are really important. I want to talk about how to measure slack. So I got to tell you, there are 2 relationships in our traditional model of the macroeconomy that I have to tell you about. One is called the Phillips curve, and it just tells us what determines inflation in the short run. For now, the only thing you need to know that inflation in the short run is driven by the amount of slack in the labor market. But we have to know how to measure that. Okay, how do we measure it? And what have we learned, or what questions arise? Now, the second thing that's interesting as these variables have moved relative to each other, well, what do you think belongs in the social welfare function? We'll call it the FOMC's loss function. Do you think it's U3? Or do you think we should include unusual movements in workers marginally attached, discouraged workers, part-time for economic reasons, all that go into U6? Do you think U6 should be in there, or U3? Now, that's not, I'm going to make a somewhat bold statement here. It's a speculation, but Janet Yellen has made some interesting comments that suggest kind of that's where she is. Now, how many of you recall Doreen, Vicky, and Jermaine? Anybody heard of those people? Oh, good. Okay. So Janet Yellen, in one of her first speeches, identified these three people. I don't know if they were all there in the room or not, but she identified these people, and she said, the plight of these people tell us that there's more going on here than just can be captured in the unemployment rate. What was Doreen's problem? Long-term unemployment. What was Jasmine's problem? Part-time for economic reasons. And somewhere I lost what Vicky's problem was, but she had a problem too. She was discouraged. Okay, that'll do. That'll make my story work very well. All right. So those are a couple of things that I want to focus on. Now, I'm going to talk about something that I call the wedge in a dual mandate. So the dual mandate is get to full employment, get to price stability. You ought to be able to do them both at the same time. Okay, that's what we like to think, and usually that's the case. Now, that's the case as long as the unemployment measure that goes into the Phillips curve is the same as goes into the loss function. We're trying to get to full employment. We're getting to U3 NAIRU. We're trying to get to maximum employment. That's U3 NAIRU. Everything is fine. But what happens if they're different? So the first thing we look at, what is it if the short-term unemployment rate is what drives inflation in the short run? But certainly we care. I always say we don't care about long-duration unemployment if we're looking at inflation, but we do care about it because U3 goes into the loss function. Now, this creates the potential for a wedge, and the wedge opens up when the gap between these increases, and there's a gap between the overall unemployment rate and the short-term unemployment rate like we haven't seen before. Now, that's a real problem. If we try to get the unemployment rate back to, say, 5.5% that we thought was the NAIRU, because there's so much long-duration unemployment, we'll have to drive the short-run unemployment rate way below its NAIRU. Okay? So we could get full employment with inflation, or we could get price stability, but away from full employment, not compatible. So we want to think about that. And we'll think about that with respect to U3 and U6. What if, a lot of talk, what drives slack? Is this narrow unemployment rate, U3? Or does it also depend on a wide range of other indicators that we'll summarize with U6? Okay? And what Yellen has said is, look, all right, U3 might be the best single measure, but all the other measures suggest there's more slack in the labor market than if you look at U3 alone. Okay, now, so what I want to do now is look at this from the perspective of monetary policymakers. Now, shocks can be of several sources. Janet Yellen always talked they can be cyclical or structural, and Betsy talked about that. I'll distinguish two kinds of cyclical. You have a recession, the unemployment rate rises, you become more accommodative, you push the economy back to full employment. But what happens if it's a very deep and prolonged cycle? Could those people who are unemployed for so long, for example, could that become structural? Call that hysteresis. Now, that has a message for monetary policymakers, and you'd be more aggressive than you otherwise would. If it's just cyclical, kind of do what you normally do, get the economy back to full employment. If you have hysteresis, take some inflation risk and be more aggressive. So what if it's structural? It's permanent. You can't do anything about it. Monetary policy can't do anything about that. You have to adapt to it. So if your two measures of unemployment are no longer compatible with full employment and price stability, you got to adjust one. Okay? So maybe if it's long duration unemployment, you just have to raise the measure of U3 that you call full employment, because full employment is really determined by the price stability and the short-run unemployment rate. But I want to talk about the most fascinating kind. Let's say that the shock is persistent, but not necessarily permanent. Think about long-duration unemployment. Think about what would happen if the Fed carried out a extraordinarily accommodative policy, as they have, but for longer than otherwise, that drove the unemployment rate below the NAIRU, even at the risk of inflation moving somewhat above its objective, and by creating a very, very tight labor market, brought some of those people who were long-duration unemployed, were viewed as unemployable, lost their attachment to the labor force, didn't search very much. Now, all of a sudden, they can find a job more easily. Employers have to dig into that pool because they've run out of the short-run unemployed to hire. Okay, and these people who are long duration unemployed come back into the labor force. Okay. Now, that's an interesting idea, and it's the same thing with U6. Okay, maybe you create a very tight labor market, you'll get that part-time for economic reasons to come down faster, maybe to normal. Same with discouraged workers, etc. It's the same thing for both of these. So, is that something is that a game the Fed should play? Well, let's ask if that's a game they are playing. So, in the meeting last week, participants revealed their forecast for 2017 for the first time, and they were eye-opening. Look what they said. They said, we think the unemployment rate is going to be below the NAIRU, 5.1 versus 5.4. That was good. That was what they wanted. Those were projections under the assumption that they were carrying out appropriate policy. If they didn't want the unemployment rate to fall below the NAIRU, they would have put in a different monetary policy and prevented it. So they wanted it. Okay. Now, the question is this. That is such a tempting trade-off. My goodness. Look at it. The unemployment rate below the NAIRU and inflation isn't above 2%. So there are a couple of possibilities here. One, maybe that's not the right NAIRU, and you got to push the unemployment rate lower to get inflation to 2%. Possible. But here's another possibility, and that is, well, it's easy to push the unemployment rate below the NAIRU and just keep policy accommodative. It's not that hard, okay? But it's not that easy to raise inflation above its objective. And that's because it's Phillips curve. Okay, sorry I had to show this. But that gray line is what the Phillips curve looks like in most models. It's very flat. That means if you push the unemployment rate down by a percentage point below the NAIRU, you're not going to get much inflation. Tenth and a half, pretty low. Wow, that's pretty good. Not only that, but another determinant of inflation is long-run inflation expectations. If they're stable at the inflation objective, they're a gravitational force. Again, it's hard to push it above without it just coming right back down. So is it too good to be true? I don't know, okay? Handle with care. The world is full of trade-offs. Now, maybe you don't get it quite right. Inflation goes up a little more. It's more persistent. And I've been making the assumption that long-run inflation expectations are stable. But what happens if they get unmoored? Inflation goes up, inflation expectations go up. Higher inflation expectations raise inflation, which raises well, you get the point. This is not good, okay? This is a vicious cycle towards a very costly outcome that the Fed would have to subsequently unwind. So I'd say in conclusion here, this is a very interesting story for monetary policymakers. There's the challenges of how to measure slack. There are challenges about where you're trying to get to. There are wedges that maybe you can do something about with policy. And that's something that monetary policymakers have to think about. Okay? Dangerous territory, though. Because there's nothing more important to a central bank than its credibility. Okay? If if that credibility gets questioned, it's hard to reestablish it. So that's my view about monetary policy.
Eric, thank you very much. I wanted to just ask you, whether you think that maybe the Fed is being too complacent, that maybe it's behind the curve, and how does this particular cycle differ from previous cycles, in the sense that the Fed's got this massive balance sheet now, $4.25 trillion, huge amount of excess reserves. Is there a danger that they're too slow in?
Well, I'm not really worried about the balance sheet per se. Policy today is so accommodative. I love policy rules. I can't write down a policy rule consistent with monetary policy being at a near zero rate as we return to normal. If you look where the Fed is expected to raise rates for the first time, the middle of next year, we could be at the NAIRU and at 2% inflation. Well, they said they were going to get more aggressive, but when does it end? They're 250 basis points at that point away from the funds rate that ordinarily they should otherwise be at that configuration of inflation and unemployment. So that's a question of just how much inflation risk here. We're talking about zero. We're not talking about being accommodative. We're not talking about being very, very accommodative. We're talking about being at zero when the economy is at full employment and price stability. So yes, I worry about that.
Okay, thank you. Why don't we throw it open to questions? If I could just ask you to please identify yourself when you ask a question, and if you're making a comment, have a question at the end. Please. Yeah, they'll bring a mic to you.
Hi, my name's Elaine Middleman. I'm an attorney, and I have some background in the auto industry. And I've followed the auto bailouts for a long time. A couple questions are, as I'm sure some of you at least know, that they now have a two-tier wage structure, and also, at least the younger generation thinks they don't need to buy cars. Like in the District of Columbia, a lot of people don't have cars. So even though the auto industry is growing, I just wonder how that's affecting, the wages and the economy in general.
Would anyone like to take that?
I can just say that employment in the auto industry has done pretty well during the recovery, and that's this past summer we saw some bouncing around because it seems like the manufacturers are now having shorter or none at all, are just closing for retooling in the summer. But that's also partly to do with the strength that you're seeing in the auto industry. So in terms of employment, they're doing as well as they've done for a very long time.
I'll actually just add to that to say that the average age of cars on the road is older than is normal, and so I think that represents potential for there to be further recovery in the auto industry.
I'm Paul London. I was in the Clinton administration, and then I had the pleasure of spending 3 years here at AEI writing a book. I'm really interested that we're still talking about the Phillips curve and the NAIRU, because if I'm not mistaken, the Phillips curve is a concept that was developed probably in the 1940s, maybe in the 1950s, when structurally almost every economy in the world was hugely different. There was no globalization, there was much less competition in almost every area. And then when we're still talking about inflation, my sense is there really hasn't been any serious inflation in the United States since 1983. And I think the incredible concern about inflation that keeps cropping up is so dissonant with the experience in the last 30 years that I kind of wonder why it remains such a central issue.
Okay, I'll just say a word about the Phillips curve. You have to understand, I'm part of the fan club of the Phillips curve. I thought the Phillips curve began with the birth of A.W. Phillips. I believe that was in the 60s, but it could go back further than that. That was discredited. Okay? But by the 1970s, we began to get a formulation of what we call the modern Phillips curve, with that vertical long-run curve, and all the rest that goes with it, and then estimates. So I want to ask you a question. What determines the price of oranges? Oh, thank you so much. Thank you so much. So what determines the price of apples, oranges, cars, put them all together? Supply and demand. What's supply and demand? Potential output relative to output in the labor market, the unemployment rate relative to the demand rate. I'm just going to say one more thing. There is no other model. There is no other model. Supply and demand. Basically, that's it. If it doesn't exist, then the Fed can't do anything, and I don't know, inflation is indeterminate, okay? So let me go on to the second story about inflation. Well, inflation's, look, Bernanke was testifying about 2 or 3 years ago and being pested about being irresponsible with respect to inflation. I'll be a little sharper than he was. And he said, what do you mean? I'm the best chairman in the history of the Federal Reserve. Look at the compound annual rate of inflation over the time I've been here. What is it? 2.0. Okay? Now, the problem is it's low. It's too low. Okay? The Fed defends the inflation objective from both sides. Doesn't want it too low. Doesn't want it too high. So that's what they're trying to do. Hasn't been easy. Okay? And part of it is what determines slack. Okay? The Phillips curve is a general concept. But we got to figure out how to measure slack, what all the parameters are, etc.
Larry, where do you measure slack?
How do we measure it?
No, where? At what level do you think the slack is right now?
Well,
I mean, Nigel seemed to say it was 4%.
Well, this is one of the things I said. I don't know anything really. I got models, I got estimates. It's the best I can do. Okay, so we would say that our best measure is still in terms of U3, that we're at 6.1, and I'll take the FOMC's kind of central tendency zone, maybe 5.2 to 5.6. 5.4 is fine with me, and that defines the amount of slack. Am I sure? Of course not. Okay, how will we know? Well, we'll see what happens with inflation. If inflation goes up less than I expect, then I guess the NIRU is lower. If it goes up faster than I expect, I guess it's higher. Okay? We learn. Okay? Very complicated world.
Nigel.
I just want to add one point you made on globalization, since I'm from the IMF, I guess I should say something international. I think one thing interesting about the U.S. is there's no goods inflation in the U.S. It's, you know, like you say, the presence of China, you see export deflators coming out of China, they're negative. Import deflators of manufactured goods coming into the U.S. is 0. And you don't just see it here, you see it in Europe as well. Manufactured good price increases in Europe are 0. So I think when I think of Phillips curves, I think of an economy that's the non-tradable part of the U.S. economy. So wash out all of what's happening in manufacturing inflation, because that's suppressing inflation, and focus on what's happening, particularly in the service sector here. And that's where we should be looking for the Phillips curve, or for some tightness in supply.
Okay, to be fair to the Phillips curve, okay, a Phillips curve doesn't leave out the rest of the world. Okay, we know that import inflation goes directly into core inflation itself. So the question is it going up persistently faster than otherwise, or is it going down, or is it going up less rapidly than otherwise, taking into account we're not a very open economy. We're pretty much a closed economy. I guess I wasn't that wrong, I guess, when I was growing up. 14% share of trade in U.S. GDP. Any particular country, a negligible portion of that. So we don't want to get blown away by stories of the impact of globalization, at least on inflation, unless we think, as some have, but I think discredited, that it's global supply and demand that determines inflation in the U.S. It determines commodity prices very well, by the way. Okay, but commodity prices don't have a lot to do with inflation over after a couple of months or quarters.
But I guess that at this juncture, the global situation, might have relevance, in the sense that what we're going to have is we're going to have the United States Federal Reserve moving to a tightening phase at a time that both the Bank of Japan and the ECB are likely to be moving towards an easing phase. So you could get very big movements on the dollar and commodity prices, that might have an impact this time around, might give the Fed some room.
Absolutely. That's part of what expected to happen. And you're right about giving the Fed room. Lowers inflation, restrains demand a little bit.
John Soliday, economist. I was thinking back on Say's law, and I was thinking about, is there much room to stimulate the demand for labor through stimulating the supply side of the economy through improved tax and regulatory environment? And if so, what suggestions might you have to stimulate business environment? My sense is it's kind of dire. I mean, not your suggestion, but the current situation. The business environment is not particularly good.
I mean, I think that certainly there's lots of scope here to fix some of the regulatory side, the tax side. I mean, I talked a little bit about the taxation of second earners being an important thing of excluding people from the labor force. I think there's scope to, we've talked about encouraging R&D as a way of raising productivity of workers, and there's scope to provide tax incentives to do that. I wouldn't oversell it. I mean, we're talking, when we think about some of these things, we're talking, quarter point of GDP or something of that order for a few years on the fiscal. So it's unlikely that's going to create a huge turnaround in incentives, but I think it does matter on the margin, to bring those people back into the labor force.
I was just going to say that, I mean, there's lots of discussion about business tax reform, and the president has proposed business tax reform. I think that this is thought of as something that would be important for long-run growth, but perhaps not working so much through boosting the quantity of investment so much as helping improve the allocation and quality of investment.
I'm Robert Dorr with AEI. Do any of the panelists feel that the slack in the labor force participation is caused in part in any way by social benefit programs providing assistance that are disincentives to work?
But I think Betsy thought not, but I don't know whether.
So obviously we must some element of that, but the U.S. social assistance programs aren't terribly generous. That it's hard to believe that they're really a major force of keeping people out of the labor force. I think it's more about the absorbing state of poverty in the U.S. When you've got 1 in 6 in the population in poverty and it's an absorbing state, that's got to really matter for getting people back into the labor force. You have children who are in poor households who don't invest, aren't able to invest in education, are detached from the labor force. I think that to me is a much more important factor than the social benefit structure alone. Now, of course, we can have a long debate about how you solve that poverty problem, and especially in this institution, it would be quite an interesting debate, I imagine. But I think there, on the margins, so things like changing the ITC seems to be a no-brainer. I mean, that should be palatable to everybody. I mean, we can argue about the minimum wage as something else that's maybe a little more controversial. But providing childcare for women in order to bring them back into the labor force, those sort of things seem to me to be reasonably sensible policies, and they're not that expensive.
Yeah, I mean, I already said that I didn't think that the social insurance programs were playing a big role. I want to echo the issues around supporting families. I mean, there's really good international research that has shown, I mean, the U.S. female labor force participation has fallen behind many of the other industrialized countries, And this has been, researchers have attributed that to the U.S.'s not keeping up with other countries in terms of offering accessible child care, support for parental leave programs, more flexible workplaces, a range of family-friendly policies that can add, that can dramatically increase female labor force participation. And I think it's important to realize that when, if you can, that when you want to help women participate in the labor force when it's difficult for them, or at least remove the barriers when they have small children, because that forms investment and attachment that will actually last for the rest of their lives, which is why you can get such big effects from these types of policies. So there's a study by Blau and Kahn that found that if the U.S. had adopted the kind of policies that other countries did on average, female labor force participation would be 6 percentage points higher, which is quite substantial.
Are these European countries?
Largely. And I should say that this has been a big effort, as many of you might know, in Japan. Japan's female labor force participation is still below the U.S.'s, but where the U.S. is flat, Japan is on an upward trajectory about to kick us, and they are aggressively pursuing child care spots. One interesting thing I want to point out about the wages, just because I do think that the graph showing how the divergence between wages and productivity growth is a really important one to realize. What's interesting is if you break that down by gender, you see that stagnation is largely occurring among men, and it's not occurring to the same extent among women. And so, I think that I don't know why that is, but it's an important part of the puzzle to realize.
Just add one thing. I mean, Betsy talked about social disability insurance. I think it's true that disability insurance, you can't explain, it doesn't explain the decline in labor force participation, but I think one thing we're concerned about, it's an absorbing state, just like poverty is an absorbing state. So once you go in, you never exit. And I think some reform in the U.S. disability insurance that would permit people to perhaps work part-time or to come in and out of disability insurance would help with participation, because the incentives are such that it's not only when you enter it, but even if you apply for it, you want to drop out of the labor force because you don't want to be seen to be working, because then how could you be disabled if you're working?
So you are saying it's a problem?
I think on that particular component, that some reform of that could actually unlock quite a bit of worker participation.
Right. Eric?
So I should tell you about a program that the BLS is engaged in with the Social Security Administration. They've realized that they need an ongoing, up-to-date analysis of what skills and physical abilities you need for every occupation in the country, even the emerging ones, and particularly the emerging ones, so that they can adjudicate disability claims. So we are working on what's called the Occupational Requirements Survey that in a few years will be available and Social Security will use to better direct people and estimate the extent of their disability. So that's a step in the right direction that Nigel's talking about.
We'll take one last question.
Mark Halfstead, economist at Resource for the Future. One of the policy responses to the Great Recession was to cut the employee share of the payroll taxes for temporarily. I'm not really familiar with any analysis that has measured the effectiveness of that policy in helping the labor market. My question is, has there been any analysis of that temporary tax cut and its effectiveness?
I think when some of the feds have done, some of the reserve banks have done some analysis of that, but sadly I don't remember who. But I think that they found it was, they were looking mostly for stimulative effect, and I think it was fairly positive.
Yeah, most people who look at that are looking for the stimulative effects of putting more money in people's pockets, not, not bringing more people into the labor force. Because you have a high unemployment rate, there's not enough jobs to go around. So the idea is, if you put more money in people's pockets, do you stimulate the economy? This Council of Economic Advisors has looked at the broad range of stimulative policies that were adopted, including the Recovery Act, and we found that they were putting about 1.6 million more people back to work through the stimulative effects, but that's putting it all together, not looking at the one particular aspect of the payroll tax cut.
I don't know. I'd give you all a chance just to say a last word. Otherwise, I'll wrap it up.
Thanks.
Can you say 2 words?
Thanks for having us, Desmond.
It reminds me, you remind me of the story, apparently, Boris Yeltsin and Bill Clinton. And Clinton asked him what was the state of the Russian economy. And Yeltsin said, well, in 1 word, good. So he said, maybe you can say it in 2 words. So he said, not good. Yeah.
Just going to say thank you again for the opportunity to talk to you. And if you have any feedback on BLS data, I'm here. Come talk to me.
Barry.
Thanks for inviting me to be on this panel, and I hope everybody enjoyed it.
Thank you very much.
Well, all I can say, the conclusion, I don't know whether I've learned exactly where the slack is in the labor market or where the potential growth is, but what I have learned is that I've had the pleasure of having the most polite panel. Thank you very much.